Hey everybody, this is Jose here. So we are about 1 minute before we start, but I just wanted to confirm that technology is on our side. You hear my voice, so please, if you hear my voice, it would be good. So we start on time, and you type a quick hello, a quick happy Sunday, something like that on the comments box. So that way, that would be the little tip, the little sign for me to know that you hear me, so we can start. We're starting in 25 seconds, guys, so please give me a good morning. Thank you so much. How are you, Buna? Good to see you, my friend. Subhash, how are you? Very good. Nice to see you all, guys. Super excited to do those sharpening sessions on the Sundays. I mean, it's more exciting, to be honest, to do it during the weekdays where we trade. But at the same time, it's a great thing to get together over the weekends and do this together. John, how are you? Maka, how are you? John Clifford as well. Yes, I heard that. Very sunny in England. Actually, I am in Spain as we speak. And, we have a saying in Spain. We say, Abril aguas mil, which means April, thousands of showers. And that's exactly what's happening. It's raining here. So not the best out there, but still happy times here. Good. Okay. Anyway, yes, Mark, good to see you as well. Wonderful. Let's get started. Okay, so I'm just going to maximize my windows here so we can begin the session. Welcome, everybody, to our April 21st, 2019 session. Today is a sharpening day. I think I said that last weekend when we talked about edge timeframes and we went deeper into the use of volume charts, tick charts, etc. And I think I said that this is getting exciting. Well, today is going to be even more exciting, okay, because I have a bunch of things to show you, and I'm pretty positive that some of the things I want to share with you is something that I would expect that many of you have never seen before, and it's going to be exciting not only because it's new to some of you, but most importantly because it's powerful, okay? So, pretty important day ahead of us in the process of building a methodology to trade intraday with futures or Forex. And, develop all those steps, etc. Okay, but before we start, disclaimer, as we always do, I'll read it the quickest I can. Let's go for it. The following videos, clips, and demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through the demonstration do not indicate in any way the results you may receive on using our products. Okay? Good. So here it's a TradeStation. Let me close the window first. Here is TradeStation. You may notice a few changes. Okay, we have a few things to talk about. The design of the workspace, because the new design of the workspace has a lot to do with things I'm going to be teaching today for the first time. As you have seen, for the ones working with us here in the get together sessions, you've seen that little by little every week. I keep adding tools, adding roles, adding certain elements with the ultimate goal of building a complete trading methodology. Of course, we are doing it little by little in the sharpening sessions over the Sundays. Of course, if we were to have the opportunity to spend, maybe a couple of weeks together in a classroom environment, we could certainly compact and compress everything into that time. But since we are spread it around the world and we are meeting online, so we are using those Sunday sessions, and little by little, we are putting together the methodologies. Okay, so every week I'm going to be adding elements to make your methodologies better or give you different choices. And in the end, we will encapsulate all those tools and new elements in the form of a methodology with rules. And then, the moment we do that, I only need one thing from you. It's called discipline. In other words, respect those rules religiously so you can implement a methodology that produces consistent action and therefore you obtain consistent results. It's that simple, okay? And I know, and we know, that it's easier to be said than to be done because we are humans and we are emotional beings and all those things. So many of the elements and the tools I'll be sharing with you have one goal, which is to make you less human. Okay, you heard that joke before. Let's trade like an alien. Okay, let's trade with the UFOs in the sense that we avoid the human element, the subjectivity, the lack of decision at times, the emotional aspect of trading. And we do all of this by getting together, by applying it together. So you have the opportunity to practice it, get your own aha moments by following certain rules. And the moment you start getting your own aha moments, you are now building experience that leads to confidence. And then it becomes very easy. Like Subhash is saying right now, you now trade like a robot, right? And, again, we are less human, okay, which is the goal of a professional trader, okay, to be very cold-minded and use the positive side of emotions, such as being excited to learn or being motivated to trade. Those positive emotions are great, but leaving all the problematic emotions like gambling or being fearful or being greedy or being euphoric, all those things, just leaving all of this on the side by having our emotions under control, okay? Anyway, so a little introduction for the day, and as we are receiving more people connecting to the session live with us, but it's now time to continue, okay? So a few things here. First of all, I want to get this document back up, our Word document. We've been making a collection of notes in the past. The way we are building the notes and the way we are building the content, it's quite informal. And I'm doing this for a purpose, for a reason. I'm doing it on purpose, meaning that, that way it allows us to learn the concepts and kind of end up with our own words on how to say the things we do, right? And that way the methodology becomes much closer to you. Andrea, how are you? Good to see you. Happy Easter. So, in the first concepts that I put in place here on this document, we talked about more precision, more evidence, more conservative. Well, I am kind of halfway into giving you a solution for that, because in order to be more precise, last weekend we did talk about volume charts and tick charts, share bars and tick bars or activity charts. And we talked about all of those, and we came up with a specific methodology on how to calculate the ideal amount of shares, the ideal amount of ticks, which I want to take to the next level. This had the purpose of getting you more precise when entering the trades, okay? Because, of course, the benefit of getting more precise is, you get more winners and less losses. That's a good benefit, of course. But also, the winners are going to be of a greater size, and the losses are going to be of a lesser size, because your stop, your entry, and your targets are located in a more precise location. And therefore, you not only gain on what is known as the win-loss ratio, but you also gain on what we call the reward to risk ratio. That's obviously a direct benefit of being more precise, and today I'll work a little more on that. But then more evidence, I never talk much about that, and this has a lot to do with the ones of you more conservative, okay? In one hand, we all understand that no matter your trading methodology, your trading context, the market environment, we all understand that the way to use the UFOs is that when the market drops into a green UFO, it's time to go long and buy. When the market rallies up and reaches a red UFO, it's time to go short and sell. So we all understand that. We've been talking about that for a long time. Many of you are using the app, so you know this very well, okay? But at the same time, at that time, when you do that, you certainly have certain level of evidence, okay? You have certain level of evidence that your entry makes a lot of sense. And actually, with the UFOs, you can even measure the statistical expected results with those UFO performance stats, okay, which just to make sure everybody is following what I'm saying, because I know that some of you in the session are new to the UFOs, and also some of you are not using the UFOs in TradeStation. You're using the UFOs in TradingView, which we need to talk more about that, by the way. But in any case, let me show you what I'm talking about. So I'm just gonna add 150 bars on the left, right? And here you can see that you have this performance metric here, 50.12, for example. If I switch to the euro, it's gonna be 57.35. So this measurement of probability is very, very useful. And you could think of this measurement of probability as evidence, right? Because, if you run the UFOs in a certain market and you have a measurement that tells you that you have, 71% probability of a winner, well, if you were to call this evidence, I get it. Okay, I totally get it. It makes sense. But at the same time, here I don't talk about evidence. What I talk about is more evidence. Okay, so how can we get even a little more evidence than that? Okay, I mean, we don't have a crystal ball, and for sure, when on-field orders are placed in the marketplace, they could be canceled. And that's why we use stops, because that would be amazing to have a methodology with 100% win-loss ratio, but that simply does not exist. So we are okay with taking trades and exposing ourselves to losses from time to time. It's okay. We don't need to be that perfectionist. But at the same time, if we were to be able to find a way to add a little more evidence, that may be useful. And notice I said may be useful, because like everything we do in life, everything got pros and cons. And here is the disadvantage. Today I'm going to show you how to add a little more evidence and therefore more probabilities, but there will be a disadvantage as well. Okay, so what is the disadvantage? Very simple. If you got more evidence, okay, well, the disadvantage number one is that you have to wait for that evidence. You have to be more reactive, and therefore there will be times where you may miss a trade because you never got that evidence and market already moved. So one downside of being too conservative and always looking for too much evidence, one downside will be that you may miss trades. The other downside is that you may find less trades that meet all your rules, and therefore you may trade a little less often. Okay? And the third downside of looking for more evidence is that at times you may get stopped out, let's say 2 or 3 times in a row. It's not likely to happen that often, especially if you are adding the technique I'm going to show you today to add more evidence. But if that was to happen, because certainly it could happen, probably you may feel, unless you are experienced, you may feel a great level of disappointment as a trader, and therefore you kind of almost feel like you want to stop trading for the week or for the month. And that's a little bit of the danger side when you become a little too perfectionist in trading. So my advice is to never be too perfectionist, but at the same time, we all have whatever type of DNA we have, and some of us together here, connected all together, some of us are more perfectionist than others. Some of you may not be perfectionist at all. Some of you may be somehow perfectionist. Some of you may be super perfectionist. And on top of the perfectionism, you may be very conservative and risk averse, or you may be very aggressive and not risk averse at all, or somewhere in between. So what I want to give you is I want to give you tools, which in the end will become rules to follow. And some of those tools and rules will apply more to certain of us and not to the other remaining part of the group, and vice versa. So just keep that in mind, because today I will be getting deeper into what I've been sharing with you in prior sessions. Just to make us more advanced and more precise and more profitable and more everything. But also I will add a few things that will be optional that you will need to assess for yourself if you want to use it or not. Because if you use it, it will make you more conservative by gaining more evidence, and therefore you're going to be more precise. All of this is good, but again, you have the downside, which is that sometimes you will miss trades, you will trade less often, etc. So if that's you, as I just said that, you're thinking, wow, that's exactly what I want. That's exactly what I want. I just want, 3 trades a week. That's it. So if you are thinking this way, then listen carefully. This is going to be very important. For the ones of you in the room that you're like, I hate missing trades. I don't want to miss not even one trade. I just want to be as active as possible. Well, then a portion of today's session will be very interesting for you to observe, but probably you will not be using those extra rules that will be optional, which I'm going to share with you today. Okay, so I just wanted to make sure you all understand what we're going to do today, because again, today I think is the first day I'm going to share more techniques and tools and rules, but some of them will be optional, where up to this point, normally the rules I gave you is always, my expectation will be that you're going to follow them, where in this case, I'm going to give you optional rules. So you will need to look at yourself in the mirror, understand who you are as a trader, understand the pros and the cons of those rules, and use them if you think it matches you, and not to use them if you think it doesn't match, they don't match you, okay? Anyway, so a little introduction for the day, a little bit of setting the expectation so you understand when I give you those rules that they are optional, okay? And listen carefully to the end, because it's going to be powerful, but at the same time, you need to evaluate if it's for you or not, okay? Pedro, how are you, Pedro? Nice to see you here. By the way, I'll be ringing you into next week, okay? Great. So anyway, so let's go for it. Take a look at this. and I'm just gonna share a spreadsheet with you. And as I share this spreadsheet, I'm gonna hide a bunch of columns first. Okay, I'm just gonna hide them just to have this spreadsheet to be more easily understandable. Okay, and then I will unhide those columns and get to explain this much better. So what do we have here? Well, we have the edge timeframes. Last week, okay, when we started going over timeframes, okay, we ended up building this table, okay, and we even went, we covered a process using RSI where we concluded that the 2-minute time frame was equivalent to the 2,584 share time frame for the S&P 500 futures, and that was also equivalent to the 600 tick time frame for the S&P 500 futures. And we did that using a specific methodology which I covered last week, which is a pretty powerful methodology that I myself have been using for many years. But having said that, let me ask you this question. Anyone here in the group have been practicing it? Anyone in the group have been playing with those RSIs and timeframes? Have you by any chance, anyone in the group by any chance, have been applying the methodology multiple days? And if you have done that, have you got the same results all the time? Have you got that the 2-minute time frame was exactly 2584 shares all the time, or sometimes you had slightly different results? How did it go on your side? Was it all the time the same results? Or maybe you did it on Tuesday, you did it on Thursday, and then maybe instead of 600 tick, it gave you 987 tick and things like that. Is it possible that it may have changed a little bit? Exactly, Pedro. Exactly. Slightly different, Orlando. Got it. So the methodology I gave you, obviously it's very valid. And as I said at the beginning of the session, as we keep spending more time together, I keep adding tools and stuff as I give you time to digest. Okay. Yes, and Mario, you were not able to find the same results. Exactly. And the reason why is because the process I run the other day, it's trying to give you some sort of an equivalency type of time frames, but at the same time, depending on volatility conditions, depending on what is your starting time to do the analysis, depending on how much data you are collecting to do the analysis, which last week I was showing you how to do it with 24 hours data, right? So depending on multiple factors, you may get different results at times. So the table you have on the left has one purpose, and the one purpose that you have on this time frame on the left, on this table on the left on the spreadsheet, is to save you time, because basically that table is my own table that I have built throughout the years, where I went through this process where sometimes there was, the equivalency was 2484, 610. Other times the equivalency was 1597, 610. Other time the equivalency was 2584, 987. And as time was changing, I was tracking all of this, and then I ended up doing some sort of a statistical approach to what is the ideal time frame that is equivalent. And out of collecting years of data, I basically ended up building that spreadsheet on the left, which it's very powerful because, if you were to keep applying the methodology I gave you last Sunday, these would be the results you find the most often. Okay, as the markets change condition, going up, going down, being volatile, being quiet, etc. Okay, so basically last week I wanted to show you how to do it, but this week I want to be a little more pragmatic in the sense of giving you the final results, and giving you those results not out of doing that application for one day, but doing that application for years, and therefore ending up with very stable set of timeframes that have been proven to be very well equivalent to the 2-minute time frame, the 8-minute time frame, or the 21-minute time frame for many years. Okay, so, and not only I gave it to you for the S&P or the Nasdaq that we did last week, we also see here on the upper the S&P, okay, the S&P and the Nasdaq, but you also have the Dow Jones, the Russell, the 10-year note, the 5-year note, the 30-year bonds, crude oil, gold futures, natural gas, copper, silver, the key currencies in futures, the euro, the yen, the British pound, the Aussie, the loonie, and the Swissy. and then some key commodities such as corn, soybeans, wheat. We got sugar, we got coffee, live cattle, lean hogs, cocoa, and cotton. Okay, for all those markets, you can see the equivalent time frames on the left, on the right for shares and ticks. Okay, and the first one on the left, okay, is for a 2-minute time frame. Okay, so a 2-minute time frame on the S&P is equivalent to either 2,584 shares, which coincides with what we calculated last week, but is also equivalent to 1,597 ticks, which is slightly different than 610 ticks that we got last Sunday. Okay, but again, the numbers I got on the left are the result of doing those adjustments for years and years, and end up with very stable timeframes that tend to remain stable throughout the time. Okay, so again, for example, some of you have sent email to us during this week. Yes, exactly. Calculated over a long time plus experience. That's it. That's what it is. Yeah. So some of you sent emails this week and you were asking, okay, so what if I trade crude oil and gold? Okay, you didn't talk about that last week. Okay, and so I responded those emails, giving you access to those timeframes. Okay, 610, 377. But now you know where it's coming from. It's coming from applying the methodology I shared with you the other day, but then you would have done it for many, many years, and then you would have come up with those statistical timeframes as a result. Okay, knowing that those numbers are all rounded to fib numbers, because we want to be close to what the institutions do, right? So we want to be close to the big players that got the on-field orders that move the market. So pretty powerful stuff. Okay, and by the way, something that we didn't discuss last weekend and even last Tuesday when we did sharpening and we were trading short term. I didn't get into the 8-minute time frame. I didn't get into the 21-minute time frame. We will at some point. With a 2-minute time frame, normally we are combining the 15-minute for the trend with a 2-minute time frame. When we do the 8-minute, it's because we are combining the 60-minute trend with the 8-minute time frame, right? And then when we do the 21, is because we're using the 240-minute time frame with the 21, 240 for the trend identification, and so on, and 21 to use those UFOs. Okay, so what's the equivalency to 21 minutes? It would be a 17,711 share bar, which is a fib number, or 10,946 ticks, which is also a fib number. Okay, so all of this is, again, out of a long period of time plus experience, like Orlando suggested. Okay, and it's all rounded to the nearest fib number. Okay, so therefore we have an equivalency where basically you don't need to worry about this anymore. You just need to take a screenshot and you have it. Okay. So this is powerful stuff. Okay, this is powerful stuff. I wanted last week to go over the process, but now this week I'm giving you the result. Okay, and remember I said that before as well, that I don't like to give you stuff and you just follow the things I say just because I said, which again, that will make me feel very well. If you basically like what I'm sharing with you and you are so happy that you are willing to follow what I say, well, obviously, you make my day. But at the same time, we are human, we are adults, and for you to be a good trader, you need to be confident. And the only way for an adult to become confident is to understand why. Okay, it's not only about I give it to you and you feel comfortable with it, so you use it. It's about you understand the rationale behind it. So last week you understood the rationale, and now I'm adding my own experience, which I cannot teach my own experience, but I could certainly share. Okay. Orlando, Jose, are these timeframes only recommended to be used for short-term trading intraday? Yes, absolutely. It's recommended for short-term trading intraday by either using the 15-minute time frame as a trend indication combined with the 2, or using the 60-minute time frame as a trend indication combined with the 8, or using the 240-minute time frame as a trend indication combined with the 21. And to be more precise, instead of 21, 8, or 2, which is time-based, you would do even better using shares or ticks. Okay, that's the plan. Mario, for the minute charts, you are using 1597 candles. How many shares and ticks for the relative charts? Right, look, you need very, very little. In the charts I have on my screen right now, if I show you, you may not believe it on how few candles I have on my screen, because really, since you trade in the direction of the trend, you don't need to load too many candles. Let me show you how many candles I got here. I got 233 candles. Okay, very small number to not to saturate my TradeStation platform. We all know the limitations of a 32-bit computer software architecture. TradeStation may get upset and freeze if you add too many bars. If you are loading one chart, two charts, you can go as far as 1,500 bars, okay? But here we are loading 5 charts with the UFOs on one workspace, and if you're gonna trade more markets, you're gonna be loading multiple workspaces with 5 charts each. That's a lot of processing power, so I'm using very, very few candles on the chart. And that's more than enough, because again, since you trade in the direction of the trend, at least in this methodology that we are exploiting, really you don't need to know much. You don't need to know what's on the left. Only a few candles back on the left. That's enough. Okay, so 233, probably even less would be enough. Okay, so more questions. Yes, Subhash, certainly we can talk about weekly income, but not today, if that's okay, because we are regularly focused right now in these past Sundays and today and the following weeks in the intraday trading. Okay, so if that's okay, I will take care of that a few weeks from now. Okay, I'll be delighted to do that, but at the moment it would be not aligned with what we're doing. Okay, Buna, but we check these charts every 6 months, right? No need. I mean, Buna, if you were to build this time frame yourself, if this table yourself, then yes, I would recommend you to double check, like I said last Sunday, every 6 months or whatever, and keep doing adjustments until sometime in the future, maybe 2 years later, you had, multiple samples of all the markets you trade, and it would be very clear for you what you want to use. But in this case, since I'm sharing it with you, and this has been produced by me throughout the years, I would say that's good enough. Okay. In any case, certainly nothing wrong with that. If you want to redo everything I did, well, last Sunday I showed you the method, so you can certainly do it yourself. Okay. And if you want to do it yourself, yes, you need to do it every few months. Subhash, yeah. So we talked about the weekly income. Mario. Yeah, Pedro, I have 3 workspace with 3 charts each and 1,500 bar running very good. Yes, I mean, and it should be okay. And it really depends on your computer as well, because even though 32-bit is a limitation, if your computer was to be real powerful, and I know you are an expert in technology, Pedro, so I'm sure that's your case. You have a monster computer. So obviously, probably that works well with you. But for traders that may use maybe a laptop or maybe a computer which is less powerful, you could certainly reduce the amount of candles per chart, and it's fine too, because the reality is that you don't need as many, right? So you can do that. Yes, Andrea, you're right. 233 bars per chart. That's what I'm using. Good. So anyway, so this is, coming back to what we're talking about here with adding more precision. Okay. Well, now you have a lot of extra precision here on the left. Again, feel free to take a screenshot. And this is powerful stuff. Okay. Obviously, I would certainly appreciate if you keep this information for yourself. Obviously, and you can see the copyright in the bottom as well, because this is obviously very personal stuff that I'm very, very, very happy to share with you guys. But in the end, it's quite personal information. Okay, so I'm counting you on that. But anyway, the information on the left is to add more precision. But what about to add more evidence? Okay, what about to add more evidence? Well, to add more evidence, okay, I want to introduce you to something that I call reactive timeframes. Okay, and to be honest, I've been using that term for a long time. So maybe I would have, I should have done like the other Sunday where you guys came up with a beautiful name. When you call these time frames edge time frames, I think it's a fantastic name. But in this case, if you don't mind, since I've been using that name for a long time, I'll be the one proposing a name here. So I'm making a proposal of using this concept of reactive time frames. And what is a reactive time frame? Well, think about it. So what is the methodology that we're using here? So we've been using this methodology where, we are observing the 15-minute time frame, right? And when price comes close to the average, okay, in a location such as this one right here, right? Ideally, you want to get in, and hopefully the trend continues and you catch a portion of the movement, which is high probability because you have the on-field orders and you have potential new orders to be added thanks to the average, and all those things that we have been discussing multiple times, and I should not repeat myself. So you want to do that, right? And again, we talked about you could do this combining the 15-minute time frame with the 2, right? This is what we used to do weeks ago. We used to do that. We were combining the 15 and the 2, and when price was falling like that, falling, and getting into the UFO, let's say that particular UFO was aligned, okay? That particular UFO was aligned with the moving average, okay? That, let's say 2910 was the value of the average, which, nicely enough, it's kind of the case, even though, you trade in the last candle on the right. So let's ignore the right side of the chart for now. Let's pretend the present is here. Okay, let's pretend this is the present. Okay, so you would have the UFO lining up with the average, and then you would just wait for price to come in, and the moment price comes in, you would buy, expecting the move to happen, and that would be your profit. Okay, and this is the methodology that we have been utilizing for many weeks, actually many months, since November last year. And we've been getting deeper into that in recent times. So last weekend, we said, okay, if instead of 2 minutes, you were to do this with a 2084 share bar or with a 1597 tick bar, well, now you have a tool to become more precise. And that was nice. But now I'm talking about, okay, instead of being more precise, I want to gain more evidence. I want to be more sure that entering the trade is going to lead to a higher probability winner. Okay? I want more evidence. Again, the price to pay is that you may miss the trade. If you wait for the evidence and it never came, and then the move happened and you never got the evidence, then you miss the trade. That's the downside. So I'm repeating that because it's important. But at the same time, how can I gain more evidence? Well, to gain more evidence, what you could do is look at tiny time frames. In this case, I'm looking at the 610 share bars. Notice that the share bar I'm using above is 2584, but now here below, I'm looking at the 2610 share bars. And what you would want to do is you would want to see those micro green UFOs forming after price got into the green UFO from the above time frame. So when price comes into the UFO from the edge time frame above, instead of entering the trade, you would not. You would wait for evidence, which is a green UFO would form in the tiny time frame below. And when you see that tiny UFO form in the tiny time frame below, not only you can see the price is turning, on top of that, you have on-field orders that are being added, which is exactly what the moving average is supposed to do. So you get to see those added on-field orders thanks to the tiny time frame below on the right. That's the reactive time frames. Okay? And what would you do then? Well, we're going to explore 2 different ways on how to enter the trade by watching the reactive time frame. That is giving you a form of a confirmation, if you wish, where the price got to where you thought it would turn, but not only is turning and you see the price turning, on top of that, you see the UFOs forming. Because price may turn with no UFOs, but if price turns and you see the UFOs, Now you have that evidence that I'm talking about. You have the on-field orders you thought were there are there. That's why price is turning. And on top of that, new on-field orders are being added, right? And what do? Well, then you would take the trade. And obviously that trade, I think it's common sense. That trade would carry a higher probability of working well because everything you thought is actually happening. Okay? It's not a well-documented guess, which is a high probability guess, but in the end is a guess. That's trading. Okay? We guess with probability on our side, but it's a guess. Okay? Even though guess is a word you may not like to hear, in the end, that's what we do when we trade, isn't it? We guess it's going to move in our direction. We do it with tools that gives us an edge, but it's not always like that, right? So if you were to use a reactive time frame, you are increasing your probability of how to do this right, okay? Of how to do this more profitably, okay? So take a look at the, I'm going to re-explain all of this, okay? And I believe you have a few questions in the comments box, so I'm going to go check your questions in a minute. But let me unhide all the columns, because now what I want to introduce you to is the reactive timeframes. So what if you have edge timeframes, which is the 2-minute time frame or 2584 share bars and 1597 tick charts for the S&P. Okay, so let's say you are trading the S&P, you're using the 2 minutes combined with the 2584, 1597, and that's how you enter the trades. Okay, and now you tell me, okay, wait a minute, I'm just a little more conservative. My personality, as I'm risk averse, I don't plan to take many trades. I just want a few and I want the highest probability as possible. So I am open to look for that extra evidence, even though I know that has a price to pay, which is I will miss a few trades. So what would you then do? Well, if you were to be that guy, then you would add reactive timeframes to your life. And how do you add reactive timeframes to your life? Well, you would pick the same time frame you had on the left, which is 2584, and now you would drop 3 fib numbers down. So from 2584, you would drop to 1597, you would drop to night 87, and you end up with 610. So the reactive time frame is 3 fib numbers down. And what if you had the 1597? So you would drop 3 fib numbers down. You will go from 1597 to night 87 to 610 to end up with 377, which is 3 fib numbers down. Okay? And that's what I have here. If I show you my S&P workspace, what do I have? I have the 2 minute with the 2584 with the 1597. All of those are my edge timeframes. So if I don't plan to be reactive, I can just wait for price to come to the average with my UFOs and do exactly what we have done many times now. Okay? But you tell me, oh, wait a minute. I want more evidence because it's my personality. Remember, this is optional. So what would you do? You will now look at the 610 share bars and the 377 tick bars, which is 3 fib numbers down from 1597, or for the shares, 3 fib numbers down from 2584. And now those are the 2 time frames below that you will call the reactive time frames, which many of you will simply ignore and not use because you will not want to be reactive to miss the trades. But some of you who may give priority to be conservative and wait for the extra evidence, you will then look at the reactive time frames, and when everything comes to play the way you thought it would, and now you got the green UFOs forming in any of the reactive timeframes, you will now be able to tell yourself, okay, I got evidence that what I thought was going to happen is happening, so time to get in. Okay? That would be a way for you to get not only more precision, but also more evidence. And that works very well with people with a little bit more of a conservative mindset, a little more risk averse, which is not bad. Okay, it doesn't need to be bad. If you, let's say you are super conservative, super risk averse, you can be a fantastic trader and be very risk averse. It's not a problem. But what you need is a methodology that is aligned with your personality, right? And that's exactly what I'm sharing with you. Let's say you are the opposite, and you are a person who is not conservative at all, and you have a tough time sitting on your hands, and you want to be in trades. right? So what do you do? Well, don't go for the evidence. Don't go for the reactive timeframes, because that's gonna avoid you taking some trades. And since you want to execute more, it's okay. Maybe you take 5 trades a day instead of 1. And let's say you got stopped out in 3 and you got profits in 2. Well, because your profits are more and your losses are less, you are profitable at the end of the day, and you did 5 trades. Where the other trader that is more risk averse only took 1. Some days profit, some days loses, but when you profit is more, when you lose is less. Well, you know what? Both traders made money at the end of the week. Okay, but in the end, both of you trade in a way that is compatible with your personality, so you have an easier time managing your emotions. Because if the way you trade is not the way you are, okay, it's going to be very difficult for you to manage your emotions and not to get euphoric when you make too many profits, or not to get fearful the day you take too many losses. Okay, so that's why I'm giving you different options, and all of these we will make it rules, and those are going to be optional rules for the people that choose to use reactive timeframes, which may not be everybody. Okay. Anyway, before I keep going, let me go ahead and take a look at your questions. Because I believe I was missing some. Let me see. Orlando, Jose, how do we design our desktops to handle so many options? Let me show you this. Okay, so here's one little trick that I like to use. It's also because I happen to be a perfectionist person. Even though, believe it or not, learning how to trade made me way less perfectionist than what I used to be 10 years ago. So I believe I got much better at many things in life thanks to trading, because being too perfectionist is not good. It makes you detail oriented, but for other aspects it's not too good. Okay, but in any case, I am a little perfectionist, and Orlando, I know you, and I know you are too. So what do you do when that's the case? Well, let's say you want to build a workspace with 1 and 2 and 3 and 4 kind of columns. Okay, because I got 3 charts and I got the matrix, right? So it's kind of like 3 blocks. And because I'm perfectionist, I would like the 4 blocks. I said 3, sorry, I meant 4. I want the 4 blocks to be same size. So what do you do? Well, it's very simple. You open a workspace, which is blank, okay? And then you grab whatever element you want to use. So I'm just gonna go ahead and use a chart, okay? And let me do this. And now I'm gonna come in here and select copy. You can also do Control Shift C. I'm using a Spanish keyboard, as you can see. So this word, it's Shift on your keyboard. So Control Shift C, right? Copy. Control Shift V for paste, or you just go to Edit Paste. Okay, and now you got 2 windows. Okay, and because I said I wanted 4, I keep doing it. Paste again, and paste again. So now I got 4, right? And what do you do? Well, now I'm just gonna arrange everything vertically, and now I got 4 charts horizontally. And what's the beauty of this? They are exactly the same size. Like the width of those charts is exactly the same. So what do you do? Well, because on the right I want the matrix, what do? I'm just gonna come in here, right click and close. So now I end up with a space. Okay, so now if I add a matrix, I can certainly now push my matrix, okay, adjust it to the right, that's easy, adjust it to the top, that's easy, adjust it to the bottom, that's easy, and the trickiest is adjust it to the other window. You can just, with a little bit of precision with your mouse, you should be able, that's it, you got it. So now you have a matrix and 3 charts, and they're exactly the same size. So, you can be proud of your workspace looking, pretty well balanced, right? What else do we have? Well, in our workspace, we also have 3 charts in the bottom, isn't it? And so what you want to do here is think about what's the smallest one. And, really the smallest one are those 2. And those 2 are exactly half of the size of the one above, which the one above is when you broke the screen into 4. So what do? how can you accomplish that? Well, you will just come back again to new workspace. Okay, you would again copy and copy and copy. So earlier I did 4. Now, because I want half of the size, I'm gonna do 8. So I got 6. That would be 7, 2, 4, 6, 7. One more. So that would be 8. And now I'm just gonna go ahead and arrange vertically again. So now I got 8 charts, and they are half of the size of the prior one. So what do? I'm just gonna copy. So edit, copy. I'm just gonna go back to the prior workspace I was building, and I'm gonna paste the chart here. Now this one is gonna be tiny, so I'm just gonna drag it down, and now with a little bit of patience and precision, you're just gonna put it here. Just make it smaller to whatever your fill is. And now I'm just gonna make a copy of it. So copy and paste. And doing that, what did I accomplish? I accomplished that those charts are exactly half of the width of the chart above. So now I just need to be a little precise with my mouse. And here we go. So now I could certainly drag my upper chart higher, and I ended up with my very precise workspace here. Okay. And then what? I need one more on the left. So what do? I would again paste. Okay, which went a second. My TradeStation is downloading historical data here. So it's okay now. So paste. And the moment I paste, the reason why I pasted it because now I have the same height as the other charts. And I can just again be precise, put it next to it, and then stretch it all the way to the left. Right? And then my upper chart, I will drag it up. And my other chart, I would drag it up. And yes, of course, this takes a little bit of time of doing it. But then you're going to be super proud of your workspace. And then you save it, and you add your AutoUFOs, and you add your moving average, and you change the background color if you wish, and you make it yours. And then you save it as ES, and then you copy, and then you save it as crude oil, and then you copy and you save it as whatever market you trade, and then you change the time frames, and here's your workspace, and that's how you build it. Okay, and I mean you can do everything manually, but this way is a way to kind of have a neat distribution of windows in the sense that they are all the same size, and that's how you save a little bit of time doing that. Okay, so hopefully that was the answer you wanted, Orlando. Andrea, Jose, I am certain all of us here are extremely grateful to you for sharing all this long year experience of yours. Of course, what are you sharing with us is much more worth than $89 a month. Thank you so much, Andrea. Yeah, I mean, again, guys, yes, for sure, we have a beautiful app running on TradeStation and TradingView, and it's powerful. But in the end, we need to give you proper support on how to use the app for you to succeed. Okay, and the greatest satisfaction we would have would be that you succeed trading, and in the end, for you to succeed trading, you have to click the button. And again, you are a human being, and even though technology is gonna alleviate millions of the obstacles and the challenges of being a trader, in the end, there are other things that it's more coming from the human side, in this case, just sharing experience and giving you rules and stuff like that. Okay, so it's really my pleasure, because it's so much fun to see our community grow. And you guys, I mean, those comments, make my day, so appreciated. But it's so much fun to see the community grow, and not only grow in the sense of being more users of the app and more people in our sessions, but also, in the sense of, emails we receive with you guys making money. Okay, so that's super. Yes, Subhash, you're asking about the stop, and I'm gonna be there in just a minute. Okay. John Hammer, I really like this, especially for the 240-21 and even longer term trades. Yes, Pedro, I solved the arrangements of the workspace by putting the matrix on a different desktop. That's also a very good idea. Also, you need to keep in mind that workspaces is something personal, and also when I do a session with you guys and I am sharing my screen, I can only share one screen at a time, and therefore, I am kind of forced to put everything in one screen. But you at home, you may be using multiple computers. Pedro's suggestion is great. You may have a workspace only for the matrix, and things like that. So you can certainly do that. John Clifford, using the reactive time frame for confirmation, could it be that your entry will be higher than the edge time frame, but you still need your stop under the edge time frame, which could increase risk? You are absolutely right, and that's why earlier I said I'm going to give you two choices on how to use the reactive timeframes. I'm getting there. Very good. Yes, Orlando, I think I did answer everything. Mark, any way to turn UFOs on and off in all windows and a workspace simultaneously? Unfortunately not, because it's an indicator in TradeStation. It runs as an indicator, and therefore indicators have I don't know how to say it. They are linked to individual stocks, and they are independent. Let me say that again. They are linked to individual charts, and they are independent of other charts. So you cannot link that. With a TradeStation, and same happens with TradingView, by the way. You can link the symbols. Okay, you can link the symbols, and you can link the time frames, which TradeStation calls interval, but you cannot link indicators. So therefore, I cannot activate or deactivate all at the same time. Okay. Yeah. So that will be it. Okay. Anyway, guys. So we've been running here for a while, and the purpose of this beginning part of today was to go a little deeper into what I meant when 2 weeks ago I wrote more precision, more evidence, and more conservative. Okay, but what I haven't given you much in that sense is rules. Up to this point, we only have one rule, and the rule we have is related to the trend, which we don't know exactly how we call it yet, but one possible name was the view, or surf the trend, or up down, or surf, or space rules, or trend ID, trend wars, trust the trend. So we don't know yet exactly what the name will be, but long story short, the first rule was about the trend, where what I was explaining up to this point, which has to do with the use of the time frames and precision and more evidence, this has to do with the trade plan that implies defining which is the price at which you want to enter, which is the price at which you want to exit if you're right, and which is the price at which you want to exit if you're wrong. Okay, so in other words, this applies to rule 2, rule 3, etc. Okay, but before I get there, I want to go a little deeper into the trend. Okay, because again, we are building a very powerful methodology here, guys. And the thing is that you have seen me execute trades on the Tuesdays, and many times I'm executing trades and I'm like, we could do this, right? But I haven't explained it yet. So there are certain things that I never did in the trading sessions on the Tuesdays, because there are certain things I haven't explained yet. I didn't have the time. So guys, the point where I'm going is that setting targets. Okay, even before stops, I'm going to start with the targets. I know, John, you were asking about the stops, and of course that's critical. I need to answer that too. But yes, Orlando, good eye. You can see the DMI there. So before I get into stops, because what I just discussed now has to do with the entry, and we have 3 components, isn't it? The entry, the take profit target, and the protective stop loss. Right? We have 3 parameters to define. Actually, we have 4 parameters to define before we take a trade, which is the entry price, the take profit target price, and the protective stop loss price. Those are the 3 minimum key parameters to define, together with the size of the trade. How many contracts, how many lots, how many mini lots, how many micro lots are you going to use in your trade? Okay, so we need to get deeper into all those components, and actually we may even use more than one target, which is what I've been doing in the Tuesday sessions. Okay, so we may even use more than one target. So again, there are many things that we need to discuss. Okay, but in any case, one step at a time, and I would like to begin with defining the targets. Okay, and this is because of two reasons. Number one, most traders around the world, especially in earlier stages of learning how to trade, which I believe, based on the emails that you guys sent to us and things like that, my guess, if I was to guess, I mean, it's difficult for me to say. You know what? Let me ask you, and feel free to reply in the comments box. If you want to keep it confidential, it's fine. But what about you type in the comments box, how long have you been trading, or how long have you been learning how to trade? So because my feel, out of your questions and receiving emails and things like that, my feel is that we are a little bit of a mix. Some of you are quite experienced. Actually, some of you are very experienced. But we also have traders in the group where you are in learning stages. Okay, and if you were to be in learning stages, what I've seen many times, and it happened to me too, is that you kind of develop a little bit of, call it a little obsession, healthy obsession, but a little obsession, where the only thing you're thinking is, I want a good entry, I want a good entry, I want a good entry. And you know what? Of course, we want a good entry. It's important. But the reality is that if you got a good entry and your target is you take profits too soon, right? Or you shoot for targets that are not reasonable, you may have the best entries in the world, but your results are going to be very poor. So the more experience you are in trading, you realize that setting targets is probably the most important part. Of course, if you are wrong on the entry, forget about it. But once you are in, not having a proper target, it's all important in the end, but not having a proper target, it's really not gonna help you well. Okay, so basically we got 3 years, 2 years, 4 years, 2 years, September 18, 4 years, 4 years, 6 months, 6 years, less than a year. Okay, so yes, again, a mix. And thanks for sharing, guys, because again, sometimes some of these questions are a little in the personal side, so it's appreciated that you guys are open to to share a little more about you. Okay. But anyway, so I would like to begin with targets. And the reason why is because the way I'm going to show you how to set targets actually depends on the trend. Okay? Because it's not the same to be in a market with a very, very, very powerful trend environment compared to being in a market with a very weak trend environment that is about to reverse or something like that. So if you trade in the direction of the trend when the trend is about to finish, you may get a 1-to-1, if you're lucky, a 2-to-1. Where if you were to trade in an environment with a very strong trend that just started moving, and that, remember, we said that, I believe it was 2 weeks ago, we said one of the things about the trend is that they tend to last, right? So if you were to enter at the beginning and the trends tend to last, well, you may have an opportunity for you to trade a very further away target. And it would be a shame that you take profits too soon. So up to this point in rule 1, when I said, look at the moving average, and if the candle is above, you're in an uptrend. If the candle is below, you're in a downtrend, all those things. But, I would like to take the definition of the trend to the next level in order for us to have a more precise entry, but also to have a much more optimal target every time we trade. Okay? That's my goal. Okay, that's what I want to show you, and that's what I want us to discuss today. And then we'll add the precision and the reactiveness and the stop and all that stuff. Okay, so basically, I need to take this rule 1 paragraph, and I really need to improve that paragraph. Okay, I need to improve it because we're gonna add more stuff, and also I need to improve it because out of some comments I received from some of you, the way I phrased it the other day was slightly in the confusing side. Some of you were a little confused with, how I define the trend. So, I'll be more than glad to rephrase it, phrase it in a better manner, so confusion goes away and everybody is 100% clear. But at the same time, I'm going to add more stuff. Okay. And also in the process of what we're doing, and I said that millions of times, and I will say it forever, you want to avoid subjectivity. The last thing you want is to add ingredients to your trading methodology that has you observe more things, and that opens the door for more possibilities and therefore more subjectivity. You don't want that. You want to remain mechanical at all times. You want a decision process the smartest as possible, but keep it simple in a way where it's black or white. That's it. Like, up to this point, we were talking about the trend. And we were mentioning the trend is up or down. Okay, great. That's black or white. Well, now we're going to talk about the trend, and we're going to talk about the trend is up or down and is strong or weak. So we'll end up with 4 possibilities. The trend is up and strong, up and weak, down and strong, down and weak. So we're going to add a few more choices, but that's it. It's going to be 4. It's not going to be 25. And it's going to be done in a way where everything is going to be assessed mechanically, so there is no room for subjectivity where you find yourself like, oh, you know what? It looks like this is going to happen. Well, the moment it looks like, that's a bad beginning. It cannot be it look like. It's either black or white. It's up or down, it's strong or weak. That's where we're going. So how we're going to do this? We're going to add an indicator to our equation. Is the DMI. Some of you noticed in the bottom part of the chart, I got the DMI indicator. Okay? There are a million different ways on how to use any indicators. There are a million different ways on how to use the UFOs. We are putting together a specific methodology, and therefore what I need to do is to explain how the DMI works and give you rules on how to use it. Right? So let me show you that. First, let me go ahead and open a blank workspace. So instead of so many charts, I'm just going to have one. Let me get my bottom chart here. Let me copy. Oh, not that one. I don't want that. Let me copy. And let me paste. Here we go. So what do I have here? So I have a chart, okay, with a DMI below, and I have the average above. Okay, now some of you guys are using TradeStation, some of you guys are using TradingView. Let me show you guys. If you insert DMI, I'm doing it with TradingView now. If you insert DMI in TradingView, it doesn't come as DMI, it comes as directional. Okay, so if you type directional movement, here we go, you have it here. So type directional movement, and you would have this kind of a little bit of a messy thing in the bottom, okay, with 3 lines. In TradeStation, it's actually the same thing. So if I hide the current DMI I'm using, and I was to add a DMI, and I was to show it to you how it comes by default, so you would go for DMI. In TradeStation, don't look for directional movement, just look for DMI. It stands for Directional Movement Index, but it doesn't show as Directional Movement Index. It shows as DMI. So you go for DMI, you click OK, and now you have the same lines we just saw on TradingView. You have it in the bottom part of the chart. Okay, now, a couple of comments, and by the way, I'll give you a little break. I'll give you a 5-minute break in just a few minutes. So I give you a little resting time. But let me, if that's okay, let me explain the DMI thing first. Okay, so when we are back from the break, then we'll start getting into the rules. So the DMI is an indicator if you've never seen it before. And also, let me make a point. Indicators, how do I put this to be politically correct? Indicators could certainly be a complete waste of time. Okay, and well, that was not very politically correct, but it's okay. They could be a complete waste of time if you were to use them for the wrong things, because indicators show you what happened already, right? So, indicators are known as a lagging tool. So many times most people use them, and it's a waste of time. What is going to be our edge? Well, our edge is, number one, we're going to be indicators to understand the trend, and even though they are lagging, because the trend tends to last, the lagging effect is not going to be so critical. And second, and more importantly, and that's the key, we're going to be timing the trade with the UFOs, not with the indicators. Okay, so the indicators will give us a reading of what's happening with the trend. The fact that it's lagging a little bit, it's okay because the trend tends to last. Ultimately, we'll know if it's okay to enter or not by using the UFOs in the edge timeframes or the reactive timeframes. Okay, so we are not going to fall into the trap of indicators that many people fall into. Okay, guys, so make sure you understand that. Okay, at the same time, the beauty of indicators is that indicators are mathematical calculations done by the computers So whatever they tell you, it's what it is, and there is no subjectivity. Okay, that's the beauty. So what are we going to do here? And I'm going to do it with TradeStation, but you can do exactly the same thing with TradingView. And by the way, I need to talk a little more about TradingView later on too, because I know that we are also a mix of traders here, that some of you use TradeStation and some of you don't. Some of you use TradingView. And the app is the same, but the platform is different and some features are also a little different. So I'll need to talk about that too, okay? So look, if you double click on the indicator, you have the access to customize the style of the plots. Right now, I'm just going to change the colors, and the ADX, I'm going to make it blue, and then the DMI plus, I'm going to make it green, and the DMI minus, I'm going to leave it as red. Why? Because I think those colors represent better what DMI actually does, which is, DMI stands for Directional Movement Index. DMI plus means directional movements to the upside. Because it's upside, I want it green. DMI minus represents directional movement to the downside. Because it's downside, I want it red. And then the ADX is kind of a mathematical calculation that takes both directional movements into consideration. And you may use that. You may have seen a session I did actually with TradingView where I was talking about using an ADX of 25 and stuff like that, but I'm not going to use it in short-term trading for futures, okay? I will simply ignore it. So the blue line, if that's okay, I would like you to ignore it, okay? And you know what? The easiest way to ignore it is when you get to the style, okay? I'm just going to make it transparent. So I just slide from solid to clear, 100%. And when I click OK, the blue line is gone, okay? So I just made it transparent. It's still there. You can still see the calculation, but somehow you don't see it. Okay, so now what do you see here? Well, you see that sometimes the green line is above the red line, and sometimes the red line is above the green line. So what does that mean? Well, when the green line is above the red, it means that the pushes that you have moving up are stronger than the pushes that you have when the market goes down. When the red line is above the green, it means that the pushes that you have going down are stronger than the pushes that you have going up. And, if you think about trend theory, trend is defined as a collection of impulses followed by corrections to be followed by new impulses in the prior direction, right? And that's how a trend evolves. So you got impulse, correction, impulse, correction, impulse, correction. That is how the trends evolve. If the impulses, just like the name suggests, are moving strong in a direction, and the corrections, just like the name suggests, are moving slowly in the opposite direction as the impulse, well then, it's reasonable to think that when the red is above the green, you are having a proper behavior for the trend. In other words, using our definition of trend, you have the close below the average, is going down, 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 but not only is going down, it's going down properly. Properly in the sense that as it's going down, it's pushing stronger to the downside, red above the green, and is correcting softly, and therefore the green is below the red. Here we got a new trend condition going up, okay, and we have the same behavior, okay, starting at this point. Okay, you could say, oh, wait a minute, not only we are in an uptrend, the uptrend is behaving properly. Why properly? Because the impulses, the green, is above the red. Okay, so you have strong impulses to the upside, etc. Sometimes you'll have contradictions. Okay, sometimes you'll have contradictions, and those contradictions will mean that, the trend may not be so strong. Okay, like for example, right here. Okay, let me get, for example, here. Okay, here you can see you got the red is above the green, okay, but price is above the average. So you got a little bit of a contradiction between what you have above and below. It's like you are above the average, should be an uptrend, but then the impulses have been measured to be strong going up. And that is the characteristic of an uptrend, not a downtrend. So we're going to be able to use those two indicators in a way where the bottom one will kind of validate the upper indicator because they're measuring two different things. And will also give us an indication of, is the trend behaving properly, or the trend is behaving in a way that is not proper, and therefore potentially setting itself for a reversal. Okay. Now, personally, I don't really like too much to see the lines the way they show below, and therefore what I have done is I changed DMI minus and plus to histogram. Okay, and then to see it like very, very thick, I just picked the second from the right, like second thickness from the right, and therefore when I click OK, it looks like that. And basically that is telling you when it's all green, what really matters is the top part. If the top part is green, it means it's pushing up. If the top part is red, okay, it means it's pushing down. Okay, so if you are in an uptrend but it's pushing down, then the uptrend is weak. If you are in an uptrend and it's green because it's pushing up, then the uptrend is strong. If you are in a downtrend and it's red, then you are in a downtrend and it's pushing hard down, so you are in a strong downtrend. If you are in a downtrend below the average, but then you got the green above, it means that even though you are in a downtrend, the pushes to the upside are very strong, so the downtrend is weak. Okay, that's how we're gonna evaluate this. And basically the DMI I deactivated earlier. If I activate it now, well, as you can see, it's overlaying the same before because it's the same as before. Okay, so basically by going over this explanation, I kill two birds on one stone, which is I explain what the DMI is, but I have also explained to you how you can reproduce this bottom part of the screen in your own computer screen. Okay. But anyway, I think I'm gonna give you a break now, and as we come back, what we'll do is we'll get into how to apply this, because again, beyond understanding what the trend is, this will also help us now to identify how to set the targets. Because if the trend is a strong one, we will set targets much further away. If the trend is a weak one, then we will collect profits very, very quickly. Or, coming back to this conservative approach, if you are more risk averse, you may simply not take the trade. You may simply discard the trade and decide, I'm not going to take it. Because if the trend is weak, you may reach your 1-to-1 safety target, but you probably won't reach your final target because the trend is weak. Okay, so I'm we're going to talk about this more precisely and start building the remaining rules to define those entry points and targets, and then we'll look at the stops. Okay. Anyway, all good on your side, my friends? Everything good? I would appreciate a little feedback here, and we will break for 5 minutes. And in the end as well, as I'm turning on the countdown, notice what I'm looking for, right? So simplicity of execution. Because when you're trading, what do you see? You see this. That's what you see. Okay, and at the moment, what do you have? You have the close is above the average, and the below is green. So before we go to break, you guys type it. Is it a strong trend or a weak trend? Strong or weak? This is the answer I need before we go to break. And look at how simple is this, right? You just look at the right side of the chart. Above the average, green or red below. That's it. Strong, very good. Fuerte, very good. Uptrend and strong, very good. Okay? Yes, subhash, yes, I will clarify that. So anyway, guys, break time, 5 minutes. See you in 5, okay? Okay, everybody, Jose here. We're back. 5 seconds to go. Would you mind to just have a quick message on the comments box just to let me know that you hear me? Quick hello, quick we're back. So that way I can start. Very good, wonderful. Thank you, guys. So let's continue, guys. Let's continue because really I cannot wait to get a little more advanced, especially with the rules. Okay. So what do we do? Okay. So that first step, okay, has to do with identifying the trend. Okay. The purpose was making sure that we are in the right side of the market as we plan the trade, okay, and this will not only be useful for entry purposes, but also to decide about our take profit targets. Okay. So that's the idea, okay? So the way we have been talking about defining the trend has been, number one, using the EMA. Okay, we're using the 9 EMA, and why? Because it's super standard. I will not repeat the whole explanation. You can find it 2 weeks ago. And looking at the prior candle close, okay? But this has been a little confusing, okay? So here's a little bit of a more simplistic way to think about this, because to be honest, it's very simple, but depending on how you think about it, this may not be the best way to write it down. Okay? So what I would like you to do when looking at identifying the trend, I would like you to simply ignore the last candle. So the last candle, okay, just pretend it's not there. That's it. There is no last candle. Okay, so ignore the last candle. And as you ignore the last candle, now you look at the close and you look at the EMA. And you will also look at the DMI. Okay? So don't look at the candle close and the EMA and the DMI in the last candle. Look at it in the candle before the last. In other words, ignore the last candle on the chart. Okay? Because you're going to be trading on the last candle of the chart, and obviously in the last candle of the chart, everything is moving. The fact that you're above the average doesn't guarantee you're going to finish above the average. Or the fact that you are below the average does not guarantee you will finish below the average. The candle may go from below to above, or vice versa. So, use the 9 EMA, ignore the last candle on the right side of the chart. Okay. Focus on the candle before the last. Okay. And if that close is if that close is above the average, you are in an uptrend. And if that close is below the average, then you're in a downtrend. Can everybody please confirm to me that this is now clearer? Because I know that there has been a little confusion before. And before I get into the DMI, I want to make sure the average thing was clear. Yeah. So ignore the last candle on the right side of the chart. Which is the current running candle based on Pedro's suggestion. Yeah. Okay, good, perfect. So we got that. Okay, and again, those rules at the moment, the way I'm typing the rules here, as I said once or twice, it's kind of like, you are my nephew, and one day you say, hey, uncle, teach me how to trade, and we just grab a piece of paper and started making notes, right? Kind of improvise, which, believe me, is not improvise at all, but kind of, right? So I'm just phrasing it this way, just so we kind of get to speak the same language, and all of this in the end, we will kind of like get it in a compacted format with very few words, very well picked words to explain what it is, and basically our rules are going to be super simple, okay? But now I'm giving you kind of like the long explanation with informal words just to make sure everybody understands, okay? Now, what else? You're going to be using DMI, okay? You're going to be doing the same thing, okay? You're going to be doing the same thing. So ignore the last candle on the right, okay? Ignore the current running candle, focus on the candle before. And if we are in an uptrend, okay? If we are in an uptrend, okay, and the DMI is green, okay, then the trend is strong, okay? If not, the trend is weak. Again, this is not typed in the best manner, okay? But you get the point. The opposite is true, okay? So if we are in a downtrend because the prior close was below the average, and we got red, the DMI is red, okay, then the trend is strong. The trend is strong, and if not, then the trend is weak. This would give us basically 4 possible scenarios. Okay, we have 4 possible scenarios, which is strong, uptrend, weak, uptrend, strong, downtrend, weak, downtrend. That's it. Those are the 4 possible scenarios, isn't it? Those are the 4 possibilities that could happen, based on the tools that we're gonna be using for this analysis. Okay, and why is this important? Well, why is it important? Because remember, trend tend to last, so that has a lot to do with being on the right side of the market. But if the trend tends to last and the trend is strong, so we are in a position where potentially we could capture a large market movement, and this will allow us to be able to understand much better how to set the targets. If the trend was to be weak, even though the trend to last, because the trend is weak, well, now the trend is less likely to reach a further away target, or even maybe the trend is about to reverse. So the way on how we would do profit taking will have to be much, much more aggressive. Okay. Just join. You missed the earlier part with what is DMI. Well, Rajwant, unfortunately, I will have to ask you to then review the recording after the session is over, because obviously it would slow us down very much to go back to that definition. But just bear with us with the rules, and then you can clarify that yourself by watching the recording if you don't mind, okay? Anyway, how is it going so far, guys? Everybody with me on those 4 different possibilities for the trend condition? Okay, little confirmation here. Good. Perfect. Okay, so let's continue. So rule number one is gonna be the trend. Okay, which we need to come up with a proper name for that, right? So what would be rule number two? Well, once you know the type of market condition in which you are, the second rule will have us define the target strategy. Okay, that's going to be the second step. We're going to have to define the target strategy. Why is the target going to come even before the entry? Well, because first, the target may be too close, and therefore it may not be worth it to execute a trade based on reward to risk ratio parameters. Second, because depending on the trend condition, some of you may even decide you don't want to take the trade. So why would you even get into looking at entries or targets? You would just stop there. Right? You want to, how do I put it? You want to get out of the way anything that is an obstacle for the trade, anything that would have you say no to take this trade. You want to assess all of that first. So if everything that is negative for the trade happens to not to be there, therefore you have an open opportunity in front of you, and therefore it's worth it to spend time planning the trade. But if you were to plan the trade starting with the entry, which seems like the most natural starting point, but then after you plan the entry, you realize that the trend is against you, or you realize the target is too close, so then you basically wasted a lot of your time. So I want to lead you into a process that adds odds in your favor, but also that saves you time. Okay, so defining the target strategy is going to be key. And in defining the target strategy, we're gonna have two choices. Okay, so choice number one for the active traders. Okay, choice number two for the risk averse traders. Okay, what's the difference? Well, the active traders, they just want to execute as many trades as possible. The risk averse traders, their objective is to be safe more than to execute more trades. Okay. Now, this definition of these two types of traders is a little extreme, because you could also be somewhere in between. For example, that would be me. I am very risk averse when it comes to taking profits, but I am very, very active and very aggressive when it comes to taking entries, which is kind of like a mixed personality as a trader. I have no problem to hit the button, but then I want to collect some profits out of the table. I want to do that very quickly. That's my kind of like my personality. And I know the importance of letting your profit runs and maximize your profits, of course. That's basic mathematics. We all get that, I guess. But at the same time, beyond mathematics, it's my personality and my genes and my DNA. And therefore, my personality is to be very, very risk averse, not taking trades and taking risk. I am very risk averse when it comes to collecting profits. So I don't even know if there is a word to define that. Maybe, if any of you, maybe by any chance, had studied psychology or something like that, maybe there is a word to define that kind of psychology trait. I don't know of any word in English language that could define that better. But basically, we're gonna have a more I am doubtful to write what I'm about to write here. A little bit of a reckless approach to risk, and we are never reckless. So I'm going to change that word in a minute, okay? But I just want you to understand my point of view. And then a very careful approach on how to manage your targets, okay? Why? Because some of you are going to be more in that risk-averse side, and therefore you want to be more careful on how you manage the trade and you take profits out of the trade. Some of you are going to be more reckless, which we are never reckless, but you kind of have a little bit more of a carefree state of mind. That may be a better way to say it. You have a little bit of a carefree state of mind when it comes to you don't care what's going to happen next at all. And by the way, that's the state of mind that we all should have when we trade. But at the same time, there are different levels, right? Because you can not care at all about if the trade is going to hit the final target or not, but you may be very concerned and eager to collect some profits out of the table. which is fine. That could be one of your personalities, where some of you may be more like, you have this burning desire to get out. You love to get in, but then you have to get out. Or the opposite. Some of you may hate to get in, but once you're in, you hate to get out and you want to stay in the trade forever. Again, everybody's different, and I want to give you rules for all those personalities. Okay, so somehow in this explanation that was, as I said before, reutilizing my words, this explanation was a little informal, but the point I want to make is that you need to have rules that match your personality. And all of us have different personalities. Okay? All of us have different personalities. And therefore, you just don't want to execute the trades the way I do, for example, just because I do. If what I do matches your personality, then yes. But if what I do doesn't match your personality, then you may want to apply slightly different rules for certain cases, for example, on how you take profits. Okay? Why? Because again, some of us are more aggressive than others, or more careful than others, or more reckless than others, or more carefree state of mind than others, etc., etc. And this applies not only to the entry, but also to the exits. The risk aversion is often a concept that is misunderstood. And I'm talking about trading psychology now, guys, okay? This is not trading techniques. This is purely trading psychology, which is amazingly, crazily, impactfully important, okay? Most people that talk about risk aversion talk about it from the point of view of entering trades. We all get that. But what about taking profits? Again, we said before that taking profits is often more important than a good entry. Because if you have a good entry but you take profits too soon, that's a big problem. So how risk averse are you? You need to ask yourself this question twice. How risk averse are you when entering trades? How risk averse are you when exiting trades? You need to understand yourself in both of those contexts, okay? So hopefully this makes sense. This is, again, critical, guys, okay? So what are we going to do? We're going to define the target strategy based on understanding yourself. And based on that, we're going to have a choice. First choice is use a safety target. So the safety target will be very useful for the people like me, for example, which have no problem to enter in a trade. But the moment I'm in, I have this burning desire to get some money out of the trade. And I'm not saying I'm going to improvise and get out whenever I feel like. I'm going to follow rules. I'm going to be disciplined. But it doesn't stop my burning desire to collect profits. The sooner the better. So what do I want to do? I want to collect profits soon because that will alleviate my trading psychology. If you are like me, you understand that. And on top of that, this will have additional advantages, like everything in life with pros and cons. So what is the pro? Okay, pros of doing that. So pros of doing that, alleviate, okay, the burning desire to take some money out of the table. Okay, for the people with a certain type of personality, that's one pro. Second pro, remove the risk of the trade. So other trades could be taken in parallel without increasing account risk. In other words, let's say you take a trade and at 1-to-1 you collect half of the profit. In other words, if you were trading with two contracts, you close one contract when that market moves 1-to-1, what would happen? Well, not only you collected half of the profits, but you also remove half of the risk. So since you collected half of the profits and you remove half of the risk, now if the market was to move against you and stop you out, actually you don't lose anything, because the loss you would collect is equal to the profit you made when you took half of the profits out at 1-to-1. So what's the beauty of doing that? Well, the beauty of doing that is that now you can run other trades in parallel, and let's say both trades end up as losses. One lost, the other one was break even, so you didn't really hurt your account much. Where if you were not to use a safety target, what would happen is that you may have 2-3 trades running in parallel, At some point, those 2-3 trades running in parallel may be all in profit, but then next thing you know, you have a major change of market conditions. Maybe something is happening worldwide, whatever, and next thing you know, now the 3 profitable trades end up 3 losing trades in a row. If you were to raise, let's say, 2% per trade, you just lost 6% of your account, right? So using a safety target allows you to add more trades without increasing account risk. Okay, if you want to be active, right? That's great. Now, if you tell me, oh, wait a minute, I just plan to take 1 trade a day. So then you don't need to do that. But that would be a pro if you want to execute more trades in parallel. Okay? So those would be the most important pros. What are the cons? Well, the cons is that you hurt the net profit of the trade. Right? So let's say you catch a move which is 5-1, but the 5-1 move, you end up doing it with half of the position. So even though it's a 5-1, your net profit is 2.5-1. And with the other contract, you did a 1-1. So 1-1 with half of the position is 0.5-1. So you made 2.5-1 and 0.5. You made a net 3-1. Out of a 5-1 move. So of course, if you reduce the size of the trades, you hurt the performance, but you increase the reward to risk relationship. Okay? Sorry, let me repeat that. I said it complete backwards. You increase the let me say that again. You increase the win-loss ratio relationship. So in trading, okay, and this is something that probably most of you may know, but just in case. So we have 2 key relationships, 2 key ratios that we play with. The win-loss ratio and the reward to risk ratio. Okay? Those are 2 key ratios that we deal with. So the larger the reward to risk ratio, you could afford lesser win-loss ratios. So for example, let's say your trades are making 8-1, right? Well, maybe you are right 30% of the times and you are wrong 70% of the times, which for most people will look absolutely terrible. And let's face it, it probably doesn't feel too good to be right 30% of the times. But the reality is that you made money. Why? Because when you made money, you made 8 times more than when you lost, right? Another way to trade maybe is to shoot for methodologies that give you 70% win-loss ratios, even though your reward to risk ratio is 2-1. So now 70% of the times you make money, but when you make money, you make less, but you're still profitable. So what is better? To profit 30% of the times and make 8-1s, or profit 70% of the times and make 2-1s? What is better? Well, the answer really depends. And it depends on many things. And the first thing is you. Because some of you, out of your personality, you may not be able to stand like 5-6 losses in a row, which is what would happen if your win-loss ratio is 30%. And your psychology may go cuckoo just because, you got too many losses in a row. And even though it's part of the game, if you had taken 100 trades, 30% would have profited 8-1. But the fact is that after you got 5 losses in a row, you just gave up because it was too much. Right? Some of you may appreciate more to be right 60% of the time, 70% of the times, 50% of the times, because now you feel better. And again, this is not about feeling better, it's about making money. And if you were to make more money being wrong more often because your profits are greater, then you should welcome a low win-loss ratio with a higher reward to risk ratio. You should welcome that, no problem. But at the same time, we are human. And if you don't feel well about your trades, odds are that you will not click the button. So in paper, the methodology will look good, but in the real world, probably you will not click the button, so those profits will never come. So what should you do? Well, you should look for a balance, some balance, some place in between. I mean, in a perfect world, you will profit 100% of the times. Obviously, that does not exist. So maybe you want to do 70, maybe you are happy with 60, maybe 50 makes you happy too, maybe you want 55. I don't know. It would depend. That depends a lot on you. And it also depends on the markets that you trade, because not all markets are as reliable. You have seen times where we have applied, for example, you apply the UFOs to the euro. Okay, so UFOs apply to the euro, let's say 5-minute time frame. Right? And what does it tell you? 71.5% of the trades, if you had taken all of them, you would have got a bounce there. Okay? But what if you apply this to the Microsoft, which is a very liquid stock? You would have got 63%. Now, wait a minute. Why is it that Microsoft is one of the most liquid stocks in the world and still it only gives me 63 where the euro gives me 71? Why is that? Well, stocks are very fragile. They only trade 6.5 hours a day. The way institutions trade them is very, very often based on short-term fundamentals. They may change their mind. They may cancel orders. Okay, and that's 63%. And that, by the way, that's Microsoft. Okay, sometimes we find stocks. The other day we were looking at, I believe it was WDC. Okay, and WDC had 53%. Actually, with the time frame we were looking at, I think it was a 60-minute time frame, it was giving 45%. So some products, some markets, which are in the theory tradable, will produce lesser probability than others, and therefore win-loss ratios that will be greater or lesser than others. And where do you draw the line? Well, that has a lot to do with who are you as a trader. Okay, good news with the forex and the futures, and especially when you turn on share bars and tick charts, probability goes to the roof. Okay, why? Because we are becoming more precise. Okay, and on top of that, we are dealing with the biggest markets in the world apart from forex, and they trade 24 hours a day, so those orders don't tend to be canceled, and there are multiple reasons. But my point is that what number will you get depends on the market that you trade, the time of the day at which you trade, what is all the other rules in your methodology, and what you should do is try to make your rules produce figures that make you happy. Because when I say happy, I don't only mean happy in the sense that you have a smile on your face. I mean happy in the sense that you have a certain level of satisfaction from your results, because if you end up in that situation, then it's very easy to manage your emotions and follow your rules and keep trading. Versus if your methodology does not produce any sort of satisfaction at all, it is very normal to not to trust what you do, to find excuses to not to trade, to not to be decisive and procrastinate and miss trades and get upset and get in revenge mode and do all the emotional trading that many people do, just because in the end what they're doing is not matching their psychology. So I don't know if you're noticing, guys, but I could not detach teaching your rules without linking it with trading psychology. Okay, which is a very big mistake that many people make out there. Could be books, could be, you name it, methodologies that people learn out there where it's like, okay, here's the methodology, follow it, done. What are you talking about? In the end, who clicks the button? It's us, and we are all different. So what I want to do is give you a methodology with rules, but I will give you certain flexibility and optional rules that some of you will use and some of you will not. And then what I will need from you guys is to practice these methodologies for a little bit of time, give yourself an opportunity with real money, paper money, you'll decide that. So you get to see the results, you get to see the impact of certain rules, and you get to decide exactly what are the rules that you will want to use for yourself. And then you'll have your methodology. Okay, and I would have given you 95% of it, but the final 5%, okay, that's gonna be the key, because the final 5% is when you customize it to you. Okay, and that's when the trading psychology comes into play. Okay, guys, so very, very important concepts here. Let me take a look at your comments and questions. Yes, Orlando, I see you add the commissions into the calculations as well. I get that. Pedro, if you are trading with 2 contracts to remove the risk, you need a 2-to-1 target. Not really. If you are trading with 2 contracts and at 1-to-1, you take 1 contract out and you are left with 1 contract, okay, and then you were to be stopped out, then you have no risk. You have a break-even trade. Okay, so you don't need to reach 2-to-1. With a 1-to-1, it would do. Okay. Mark, also as life goes by, your risk aversion can change. Very good, Mark. Super important point. As life goes by, as you develop experience, as you get to It's not the same to trade an account with 10,000 and trade an account with 250,000, for example. It's not the same. So, if you have built that account, your level of confidence is to the moon, So obviously, you may get much more relaxed at certain rules where in the beginning part of your trading career, you were very, as I said earlier, very risk averse, that careful guy I was talking about, where, later on, you are much more in the carefree state of mind side. And it's not because you're reckless, but it's because, you truly don't care. You don't care because you know what happens when you trade, because you have proven statistical results for some time. And therefore, if you were to lose in the next trade, it doesn't concern you. It's part of the game. Okay, so very good point, Mark. Devan, can you display clock? This will help to our time lags. Our time lags should be about 10 to 20 seconds, Devan. So I can certainly show you the clock. Obviously, the clock you see, it's a Spanish time zone. So 4:49 p.m. is my time right here, right now. You can see on the bottom right. So you guys should be, 4:48 something, 4:49. Okay, whatever that is in your time zone. Moshi, I trade Forex, but I am trying to apply this. Yes, you will be able to do that too. And again, there are so many things I need to explain to get to the final methodology, and we are only spending 2 hours at a time. So believe me, guys, I'm doing my best here to get to the end result, which will take a few more weeks. But I know that some of you don't trade futures, trade Forex. So believe me, we'll take this and we'll apply it to Forex too. And also, I know some of you, instead of TradeStation, you're using TradingView. So believe me, we will also apply the same thing within TradingView as well, okay, for the ones of you, using TradingView for those trades. So we'll do all of this, okay? But at the same time, it's how many things I can do in parallel. So, when I share concepts with you and I share the methodology, to be honest, it doesn't matter which platform I use, because in the end is the concept and is the methodology, okay? Iftikhar, good to see you, my friend. However, I feel it is important to maintain that same discipline and rules no matter what is the size of your account. 100%. One thing is to have a carefree state of mind. You cross the line, you become reckless, and you just destroy yourself. And by the way, the bigger your account, the faster you destroy yourself. So the discipline and the rules, my friends, is the key. What a beautiful app we have with the UFOs, right? It's amazing. Well, if you use the UFOs with no discipline, what's going to happen, right? We know what's going to happen. You're going to hurt yourself, even though the UFOs are great, right? So it's key, guys. Okay, it's super, super key. Andrea, I thought Forex is more weekly trading and less intraday. You could certainly do intraday with Forex, Andrea. Okay, now there are certain requirements that would be there. For example, the broker you use needs to be not only a good broker, it has to be an amazing broker. You need to have very, very tight spreads, so there are multiple things that we need to talk, and we'll discuss that. I would say for the very short term, especially if you're going to go the route of tick charts, share bars, you need centralized products to do that. Okay, you cannot have share bars on Forex. Okay, you can use the 2 minutes and the 1 minute. You can use the 2 minutes and the 30 seconds, right? So you can do stuff that come close to what I'm explaining, and it would be useful. But obviously, the level of detail, precision that you will have with futures will not happen with spot Forex. And therefore, I get your point, and I agree. If you were to, instead of apply this to the 2 minute time frame and 15, you were to apply it to the 8 60 minutes or 21 240, it would be much better in the case of Forex. Much better. Okay? Much, much better. Anyway, let's keep going here. A few more questions. Jose, how did you hide the time frames around your charts? How did I hide the time frames? I'm not sure what you mean by that. Orlando, I'm sorry. Can you rephrase it, please? Can I ask a TradeStation question on alert management to help trade management? Yes, please, of course. Yes, Buna, I would love to learn intraday Forex. We'll get there. Moshi, I need help with Forex settings as well. Last week, it flew through the supply. Yes, not a problem. We'll get there. Again, I so wish I could just snap my fingers and and have the whole thing laid out for you guys. It'll take a few weeks, okay? So you guys bear with me, please. And I know that's what you plan to do. Rajwan, tick charts or share bars not available on the IB platform. Yes, not available on all platforms. That's one of the reasons as well why we use TradeStation. TradeStation is super powerful. And some of you, by the way, use TradeStation to trade with. Some of you use TradeStation only to chart. I mean, it takes $500 to open a TradeStation account with no maintenance fees, with no data feeds, and now you got TradeStation and you can chart, right? And so let's say you tell me, you know what, I love Thinkorswim, I love interactive brokers, I want to execute with IB, I want to execute with the broker of my choice, but I want to have access to the charting technology of TradeStation because it's really powerful. I mean, you could just do that. Just open an account with $500, right? Now you have the platform, no maintenance fees, no data feeds, and now you could have your share bar, tick charts, or the whole thing, and then you would just have two softwares in your computer, which is TradeStation and interactive brokers, or TradingView and Thinkorswim. It's in the end, it's very personal. Certainly, TradeStation is one of the most advanced charting softwares in the world. Okay, and that's why we use it. Okay, together with TradingView, which is the most global charting software in the world. So by combining the two, it's really when it's amazing. Pedro, run away from Forex, trade the futures markets. Well, I think that every market got its opportunities. Okay, and certainly Forex, it's a good one. But again, the lower the time frame, the more impact futures will provide for you as a trader. The higher the time frame, Forex is going to be just as good as futures. TradeStation not available in Canada. Our Canadian users utilize TradingView, and then they either trade using IB in Canada or they use other local brokers in Canada, and they do the charting and the analysis with TradingView, and then they execute with their broker of their choice. Okay, I mean, if you really want to push it, you can live in Canada, incorporate an LLC in the state of Delaware in the US, and open a trading account under the name of your US corporation, and now you can get access to charting. You know what I mean? So you can look at workarounds. I would say it's not really worth it to make it that complicated. I think TradingView is more than enough, but at the same time, for the most perfectionist traders in the group, you can also do that. Okay, Subhash, how can I set alert when I can see once trade alert is triggered? How can I set alert, and where can I see once trade alert is triggered? Okay, with TradeStation to set alerts, okay, I mean, I guess that what you want to say, or you want to see, I should say, is that, let's say, for example, you are planning to buy where this UFO is, and because the price is currently here, you want to be alerted when this is falling, and gets closer to the UFO. You want to be alerted, so you can go ahead and reconsider the trade and place an order. I guess that's the case. So what would you do? Well, you would just draw a horizontal line on the chart wherever you want to be alerted. Okay, let me make it darker so you see it better. And then you would basically just double click on the line, okay, and then here in alerts, you would just enable alert, okay, and there are multiple options for you here. Alert continuously, that means that whenever this market, was to drop and hit the line, okay, it would just keep reminding you, alert, right? Or if you want alert once, it would alert you once, hey, you hit the line. If you want to alert once per bar, every time a new candle crosses the line, it would alert you once per candle. Only once per candle, but every candle. So you got these for you to choose from, and then you have the global messaging preferences, where you can use just standard settings, or you can use custom settings. So if you click custom settings, you can configure all of it. You can have an audible sound. You can have a visual pop-up show up on the screen, stay there forever, stay there for 5 seconds. It's all customizable. And you can even set up emails. So you are being sent emails. And by the way, some telecommunications providers will give you emails where if you send an email to a certain email address, actually this becomes an SMS message that you receive on your phone in the form of SMS. So, you can do many things with it. What is the downside? Okay, and by the way, since Pedro is with us, Pedro and I will have a conversation next week. I want to make a comment, Pedro, so you can think about it and maybe you can give us an answer in future sessions. But the only downside of having those alerts is that TradeStation has to be running, and the problem of that is that what if you're traveling? What if your computer is off? Okay, so there are ways to have your TradeStation on the cloud running 24 hours, and therefore this would allow you to have those alerts trigger and you be alerted even if you're not in front of your computer screen, or even if your computer is off, because you have TradeStation running in the cloud using some virtual private server technology, stuff like that. Okay, but that's how far I'm gonna go, because now we are becoming a little too technological here, even though it's important stuff. Okay, Orlando, yes, your charts do not show the maximize and minimize buttons on the linking. Oh, okay, I got it. Yeah, so when you go to preferences, I like to save space on my charts. So when you go to preferences and you look at desktop preference, I have in the let me see, general view. Yeah, so view, I have hide all title bars. So when you do that, basically it shrinks the top part of your TradeStation windows the way I have it, which is very thin, and it saves some space. You still have the functionality. I can still come in here and right click, and I have my maximize, minimize, and everything, but it doesn't show automatically, because the fact is that I don't plan to do anything to my windows. I just want them to stay like that. So I save a little bit of space. Is TOS available in Canada, and does it have tick charts and share bars? Well, I believe that TOS does have tick charts and share bars, and I am not 100% sure it's available in Canada. I know Interactive Broker is for sure, not sure about TOS. I may try TradingView or TOS if available in Canada. Yeah, TradingView for sure. Yeah, and by the way, again, I'm a little bit of deviating here with the technology, but guys, you are having very good questions and I need to answer. So here's one thing you can do with TradingView. Okay, so for example, there is something called CQG Continuum. So CQG, in case you guys never seen CQG before, so CQG is trading software. Okay, here's CQG. This trading software is normally very, very professional. So most brokers don't offer CQG by default, but some of the professional brokers out there do offer CQG. So if you were to open an account with a broker that does provide CQG, there are many futures brokers that provide CQG. You can just Google it, you'll find many. So, and you have CQG Continuum, right? It's called CQG Continuum. So what happens is that now here, when you get to TradingView, let me go ahead and trading panel. So you see, you can activate a CQG data feed and connection with the brokers that have CQG Continuum. In other words, what am I saying? That you could trade from TradingView via the broker of your choice. So you can use TradingView not only as a charting tool, you can actually use TradingView as a pure trading platform. Okay, you just need to use a broker with CQG Continuum, which there are many. Okay, so it's pretty cool because, to be honest, they are very, very good tools with this platform. For example, you can you can do this. Okay, you have these order placement tools. Okay, where you decide where's the stop, where's the entry, and where's the target, and you just put this on the chart. Okay, and let's say you have this green UFO there, all that stuff. And then, you know, the moment you have your trade aligned with the entry here, the stop is below, the target is above, you can just right click, okay, and, you know, place the order from here. Okay, you can just place the order from here. And, or you can just execute the orders as well using the order tool. Well, actually, I need to connect it. Let me connect it to paper trading. Okay, so it allows me to place the order. So let's say I want to buy. I can just buy. It's a non-tradable symbol. You give me a second. Let's say I do that with the euro. So if I click buy, okay, now I got here. I can have my take profit and my stop loss, and I can have my limit entry price. So I have my entry price, my target price, and my stopping price. And when you click buy, so then the whole order goes in the system. And if you are using a CQG broker, all of this is executed from TradingView. You don't need to use any other software. And by the way, you also know that TradingView have the mobile app, so you can use it in tablets and also mobile phones. Okay, so all that stuff it's quite powerful. Even though I totally diverted from where I was going in the methodology, even though those are very good questions, guys. So I had to answer. Let me see. Yeah, cool. Okay, perfect. So guys, let's continue. Okay, and we are hitting now 2 hours for our session, so I plan to continue maybe 5 to 10 more minutes, and we'll call it the day. But basically what we have is we are going to be defining a target strategy. A target strategy where, number one, we would have to decide if we want to use a safety target or we don't. Okay, so this one is optional. Okay, and number two, we need to define the final target, where to completely close the trade and get out and be ready to plan a new trade. But that one is completely over. Okay, so now to use a safety target, okay, where you now know the pros and the cons. Okay, this is going to be done, okay, by doing a mathematical calculation. Okay, we will look at the distance, okay, distance between entry and target, sorry, entry and stop, okay, and we will add this to the entry. Okay, very simple. So let's say your entry is 2909 and your stop is 2908. Okay, I'm just gonna ignore the 50 just out of simplicity. So let's say you have a 1 point distance between entry and stop. So your entry would be located at 2909. Your stop would be located at 2908, okay? And your safety target would need to be located at 2110. Why 2110? Because the distance between entry and stop is 1. So you took 1 and you added 1 to the entry, which is 9. 9 plus 1 equals 10. In other words, the distance of the safety target is equal distance from entry to safety target is equal distance from entry to stop. Okay, so you do that. That's what we call a 1-to-1, isn't it? So mathematical calculation, distance from between entry to stop, we will add this to the entry and close 50% of the position size. Okay, the position size. So in other words, if you bought 2 contracts, you close 1. If you bought 6 contracts, you close 3. 50% of it at 1-to-1. That's a safety target. What is the purpose of the safety target? Remove the risk of the trade so you benefit from the pros below. What is the downside of using a safety target? You suffer the cons. Okay, so you need to assess, because remember that one is optional. You need to assess based on your trading personality, based on who you are as a trader, if you feel that this makes sense to you or it doesn't. And then no matter if it does make sense or it doesn't make sense, my suggestion is that you practice it for a while So you get to see it implemented in your trading, you see the results, and then you can have a much better decision about, yes, I want to use it, no, I don't want to use it. There will be times, let me tell you, there will be times where it will be very useful. There will be times where you will leave money on the table because of the safety target, because it reduces the size. Okay? So again, you need to understand the pros and the cons, and the best way to understand the pros and the cons is not only that I say it and you listen. The real way to digest the pros and the cons is that you practice it, so you get to internalize it out of practice, and therefore you will be able to have a very strong decision, which is, yes, I want to use safety targets, or I don't. In trading, I always use them. That's me. Okay? And again, you've seen me trade before, and you've seen I use them all the time. But again, that's me. There are cases where they hurt me. There are cases where they help me. Okay? Based on my trading personality, I appreciate them. But it doesn't need to be you. So that's first case. Second case, we need to define a final target. But the final target will depend on the trend. Okay? It will depend on the trend. And this means that we're going to have two different methods to set the target. Targets when the trend is strong, and targets when the trend is weak. Okay? It's two different ways on how to set the targets. Okay? When the trend is strong and when the trend is weak. So what are we going to do? Well, again, remember, when you are in a trending condition, okay, in this case, for example, in the S&P, we have an uptrend. Okay? The average is moving up, price is above the average, we are in an uptrend. And what tends to happen in an uptrend? Well, what tends to happen in an uptrend is that the red UFOs tend to not to work too well. And why is it? It's very simple. It's because the big players that create the uptrend, they cancel the sell orders to add buy orders. Okay, so they add buy orders in exchange for canceling sell orders, and therefore, in an uptrend, the green UFOs tend to work better and the red UFOs tend to work less. Sometimes they do, but many of them will work less well compared to the green. And in a downtrend, the opposite is true. In a downtrend, buy on-field orders tend to be canceled. So green UFOs tend to not to work as well in a downtrend compared to the red UFOs. In a downtrend, they work better than the red. In a downtrend, the red UFOs work better than the green. Okay? So therefore, when it comes to taking profits, and especially knowing that, at least in my case, I'm going to use safety targets, which means that mathematically speaking, I'm going to calculate when to unload half of the position or remove the risk of the trade, and I cannot lose anymore. Then I'm not going to be in a rush, or I'm not going to be really needing to be too precise to take my profits. Okay, so the concept of using share bars and tick charts, I will apply this to the entry, but I will not apply it to the targets. I could, and it will not hurt you, but I may make my trade to be just a little overcomplicated. Okay, and I don't want to do that. Okay, so we will use the tick charts and the share bars not only for entry. We will use them as well for trade management, which is another discussion that we need to have. But I would want to look at targets in the simplistic way as possible, because targets, even though they are very, very important on how to assess, they are not going to be that critical given the fact that in an uptrend, sell orders tend to be canceled, and in a downtrend, buy orders tend to be canceled. Okay? So what am I going to do? It's very simple. The same time frame I use to identify the trend, which is the 15-minute time frame, this is the time frame that I will use to set my targets. Now, this is if the trend is weak. So if the trend is weak, okay, if the trend is weak, okay, so you will set targets when the trend is weak by using the common time frame. Remember the common time frame? In this case, the common time frame is the 15-minute time frame, and the edge time frame is the 2-minute time frame. So if the trend is weak, I will want to respect the red UFOs found in the common time frame. In normal cases, those red UFOs will not work too well if the trend is up, but because the trend is weak, the red UFOs may have an impact bigger than what I want. So what will I do? I will just take profits wherever I have a red UFO in the 15-minute time frame. So in here, I would need to kind of zoom out a little bit to see if I have a red UFO at some point. Oh, actually, wait a minute. For me to be able to see red UFOs, I also need to turn on the UFOs, which is not on at the moment. So here's my UFOs. Okay, here I may need to add okay, it's coming. Okay, now, okay, I got 1,500 bars, it's all good. So in the 15-minute time frame, I don't have any red UFO close by. So if I don't have any red UFO in the common time frame, then I will go for the next one. And the next one is 60 because we are moving within common time frames. Okay? To set targets, we're going to be using common time frames. So when the trend is weak, you will be using the current common time frame and increase if needed. In other words, if I find red UFOs in the 15, that's it. That's going to be my target because the trend is weak. If I don't find red UFOs in the 15, then I will go to the 60 or the 240 or the daily or the weekly or the monthly. If the trend is strong, okay, I will be setting my target by using a common time frame greater than the current common time frame. In other words, which by the way, that's the case. If you look at, let me do this again. If you look at our current trend condition, right? What do we have? In the 15-minute time frame, we have the close above the average and we have green DMI. So what does that mean? It means the trend is strong. So if the trend is strong, to find the target, you are not going to be using the current common time frame. What is the current common time frame? It's the 15. You have to use a common time frame greater than the current common time frame. And what is the greater one? 60. Correct? Because we are moving within common time frames. So what is the 60? Well, the 60 does give me a red UFO. Okay, and what is the value of the red UFO? The value of the red UFO is 2918. So what's my target? 2918 is my target. That's it. Okay, so you will be doing that. Okay, we'll be practicing this together next Tuesday in the training session. Okay, so you will see that in action the next Tuesday. But bottom line, it depends if the trend is strong or not. And by the way, if it's downtrend, it's the same thing. Okay, strong and weak doesn't mean up or down. It could be up and strong. It could be up and weak. It could be down and strong. It could be down and weak. Okay, remember it's four cases. Okay, we have them here on the top. 4 cases. So if the trend is strong, you will be using a common time frame, but that common time frame will need to be greater than the current common time frame. Right? If the trend is weak, what does it mean the trend is weak? It means that you are above the average, but the DMI is red. Okay? So if the DMI is red, it means the trend is weak. Even though you are above the average, the trend is weak. So what will you do? Well, then you will want to use the same common time frame, in this case 15 minutes, and find UFOs in that time frame, which you may find or you may not find. So if you don't find them, then you keep moving up timeframes from 15 to 60 to 240 to daily to weekly to monthly until you find UFOs. But you will not get original with the timeframes. You will not look at the 77 timeframe, for example. You will go for the common timeframes, which are the timeframes that everybody uses, because we're talking about target setting. Okay, guys. So let me look at your questions and we'll call it a day. Okay, because I think that you guys have been doing a great job here, staying with me for these 2+ hours. But I think that we all need a little rest here after everything that we learned today. So let me take a look at your questions. Maca, Jose, can you go over the calculation again if possible? Yeah, for the safety target, Maca, it's very simple. It's just a 1-to-1. So if your entry is 09 and your stop is 08, okay, and let's forget about the 0.5. If the entry is 09 and the stop is 08, you have 1 point of risk. So where is your safety target? Is 1 point above 9, which is 10. Okay, so you just calculate the size of your risk, which is 1 point in this case, and you project that above the entry, and that would be your safety target. It's that simple. Orlando, I'm watching this session again. There is a lot to process here. Yes, I know. I mean, it's non-stop for 2 hours. And some of the things I say really are very basic. And for some of you, maybe it could be even a little too slow. Some of you earlier said you have years of experience. So I understand some of the things were maybe even a little slow. But even if it was a little slow, I've been talking non-stop. So, and by the way, normally I talk fast. So it would be very healthy to watch it again, Orlando. So yeah, good one. Mark, so use the UFO or a tick or two before the UFO, or a percentage of the distance from entry to UFO. Would that be for the stop, or would that be for what, Mark? I'm not sure I follow you there. John Clifford, good session, Jose. Nice to have exact rules laid out. Yes, and more rules coming, guys. Okay, and more precision. And again, no room for subjectivity. I'll give you room for choices. Some of the rules I'll give you are optional, so you can choose if you want to use them or not. But the rules will be defined with no room for subjectivity. Okay, guys? So we're going there. The reactive time frame again? Yes. So if you guys want to take a screenshot, go for it. Here's the whole set of time frames. Okay, Maka, you got it. Mark, perfect today for final target. Okay, you got it. Oh, for the final target? No, for the final target is just the price of the UFO. Whatever the UFO is, if the UFO is whatever, 25, so the target is 25. You are not going to do 25 minus 2 ticks or things like that. You just go for the UFO. That's it. Remember, you have the trend on your favor. Okay, we are taking profits out of being careful. But remember, sell orders tend to be canceled in an uptrend. Buy orders tend to be canceled in a downtrend. So you should be able to get filled even if you use the very same price as the UFO. Okay? Subhash, amazing session. Learn every time something new to build further in short-term trading. Love it. Thanks for your comment and beautiful trades, my friend. Okay, you are sometimes posting trades in our website and good ones. Congratulations there. Buna, thank you so much for your time, Jose. My pleasure, Pedro. Very good session, Jose. Hope to talk with you soon. Yes, Pedro, I'll give you a ring tomorrow morning. Okay, Spanish time. Thanks, Jose. Orlando, thanks. Yeah. Thanks. Wonderful, guys. So we're done for today, guys. Thank you for joining me. Thank you for getting together all together. Love the teamwork and the interaction. Happy Easter, everybody, as well, and enjoy the remaining part of Sunday. Bye, everyone. See you on Tuesday for the getting together for trading. Bye. Take care.